A $100 billion loss in just 4 months. That sounds like a pretty bad deal, right? No, Wall Street might just be one of the most complex games ever played, but one thing always confused me: the idea of a sure thing. I mean, how can a hedge fund run by literal Nobel Prize winners and the smartest minds in finance almost collapse the entire global economy? And why were they so convinced they couldn't lose? So let's tackle that question. In this video, we're going to explore just how long-term capital management, a fund full of geniuses, nearly broke the world. So buckle in, it's going to be an interesting one. So before we go into the details, there are a couple of basic facts that we should be using in this video. LTCM's strategy was based on something called arbitrage. In simple terms, they would find two very similar assets, like two different government bonds, where one was slightly cheaper than the other. They'd buy the cheap one and sell the expensive one, betting that their prices would eventually converge, giving them a tiny profit. By the way, these geniuses were supposed to be so smart and risk-averse, so the choice of using insane amounts of borrowed money always escaped me. But I digress. The key idea here is leverage, using borrowed money to amplify your bets, so the more they borrowed, the bigger their potential profits, and the more of a baller they were in the financial world. Okay, let's get started with the main characters. Fans of finance will know that LTCM was founded by a who's who of Wall Street legends. So who was on this dream team? The most famous names were Myron Scholes and Robert C. Merton. These two weren't just brilliant. They had literally won the Nobel Prize in Economic Sciences in 1997 for creating a groundbreaking formula to price financial options, known as the Black-Scholes-Merton model. It was the mathematical equivalent of discovering a new law of physics for the financial markets. It felt like they had a crystal ball. They were seen as the wizards who had tamed risk itself. Joining them was a roster of PhDs from the world's top universities, including MIT and Harvard. These weren't your average traders. They were quantitative analysts who believed the market could be understood and predicted through complex mathematical models. Leading this pack of geniuses was John Meriwether, the former head of bond trading at Salomon Brothers and a living legend in the industry. His team at Salomon had been so profitable they were nicknamed the Big Swinging Dicks of Wall Street for the sheer size of the trades they made. When Meriwether brought this team together to create LTCM, investors were literally begging to give them their money. This wasn't just a hedge fund. It was the financial equivalent of the 1992 US Olympic Dream Team for basketball. They had Michael Jordan, Magic Johnson, and Larry Bird, all on one team. How could they possibly lose? The problem with making tiny profits on each trade is that you need to make a massive number of trades to earn real money. So how did LTCM turn pennies into billions? A YouTuber named Plainly Difficult actually managed to break down their insane use of leverage. Based on their balance sheet in early 1998, LTCM had about $4.7 billion in equity, which is their own money. But their total assets, the amount they were actually trading with, was a staggering $129 billion. Now, if you run the numbers, that gives you a debt-to-equity ratio of about 27-to-1. For every $1 of their own money, they had borrowed and were trading with $27 from banks. To put that in perspective, a typical company might have a ratio of 2-to-1. LTCM was playing a completely different game. Their total borrowed amount was around $125 billion. But that's not even the craziest part. Their balance sheet didn't account for their off-balance sheet positions in derivatives, which were estimated to be worth over $1.25 trillion. That's trillion with a T. Now, this YouTuber actually took a deep dive into financial reports from that era, showing how a small move in the market could wipe them out. For example, if their massive portfolio of assets dropped in value by just 3%, it would completely erase all of their $4.7 billion in equity, leaving them bankrupt. Now, hats off to this YouTuber for explaining it so clearly. All their complex models said that a global market meltdown was a 10 sigma event. Something so unlikely it should only happen once in the entire history of the universe. So what was the trigger that made the impossible happen? An economist on Quora, named Alex Reichman, actually managed to trace the contagion back to a single event on August 17, 1998. The Russian government defaulted on its domestic bonds. To LTCM's models, this was just a localized problem in a minor emerging market. But to real-world investors, it was a terrifying signal. Everyone panicked at once and started selling risky assets and buying the safest things they could find, like US Treasury bonds. This was the exact opposite of what LTCM's trades were betting on. They were betting that the price gap between risky and safe assets would shrink. Instead, the gap widened into a canyon. This phenomenon is called a flight to quality. All of LTCM's carefully planned arbitrage trades started losing money, all at the same time. The Russian default was the single domino that started a chain reaction across the globe. Now, the Quora user actually used charts from that period to show how markets that seemed completely unrelated, from Latin America to Asia, all started moving in perfect, terrifying lockstep. It was a global financial pandemic, and LTCM was patient zero. Now, hats off to this Quora user. The fund was bleeding money at a catastrophic rate, losing hundreds of millions of dollars every single day. By mid-September 1998, they had lost nearly all of their capital and were on the verge of complete collapse. So what happened next? A journalist from the New York Times named Joseph Kahn actually detailed the frantic, behind-the-scenes rescue effort. With LTCM facing imminent failure, the Federal Reserve Bank of New York, led by its president William McDonough, saw a much bigger problem. If LTCM went under, it would have to liquidate its $1.25 trillion in positions at fire sale prices. This would crash global markets and could potentially bankrupt the very same Wall Street banks that had lent LTCM all its money. So, over one tense weekend in late September, McDonough locked the heads of every major Wall Street bank in a room and effectively forced them to bail out the hedge fund. The final rescue package amounted to $3.625 billion. A massive cash injection in exchange for 90% ownership of the fund. It was an unprecedented private sector bailout organized by the government to prevent a systemic collapse. Now, the journalist actually got access to internal memos and interviews from that weekend, painting a picture of sheer panic and desperation at the highest levels of finance, where the world's most powerful bankers were forced to save the geniuses who had nearly destroyed them all. Now, hats off to this journalist. After the bailout, the original partners of LTCM were left with just 10% of the company they had built. So how much of a lesson did they really learn? An author named Roger Lowenstein, in his book When Genius Failed, actually managed to calculate the personal cost to the partners. Before the crisis, the 16 main partners at LTCM had a combined personal net worth of about $1.9 billion, with most of it invested directly in their own fund. After the collapse and bailout, their collective wealth was wiped out. John Merriweather, for example, reportedly lost nearly his entire fortune. But here's the kicker. This was the money they had made. Asterisk. At asterisk, the fund, their initial wealth before starting LTCM, was still largely intact. They weren't broke. They just weren't billionaires anymore. The arrogance was staggering. Even during the bailout negotiations, some partners were reportedly still arguing with the bankers, convinced their models were right and the market was wrong. They saw the bailout not as a rescue, but as an unfair theft of their future profits. It was the ultimate arrogance tax. Now, the author actually sifted through financial disclosures and personal accounts from the partners to show the disconnect between their paper losses and their real-world financial security, revealing that while they lost a fortune, they were far from ruined. Now, hats off to this author.